Thanks very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the ongoing series of the Greenwich Roundtable. Our topic this morning, surviving the down and prospering on the turn, is our attempt at keeping a cool head and plotting a course for when the storm is over. We began the series when Ted Seides urged us to keep an eye on the brewing subprime tsunami almost 2 years ago. Today we'll hear from three practitioners who seem poised to add new meaning to the Chinese proverb, crisis is another word for opportunity. Before I briefly introduce them, may I say that our speakers' views are their own and do not represent the views of the Greenwich Roundtable members or its trustees. Stephen Blasnik is the head of Park Central Global Fund, a $2 billion hedge fund, as well as the Perot family office, where he has been managing investments across a broad set of strategies since 1987. Before Perot, he was a tax attorney with Hughes & Luce. Before that, Steve was trained as an aerospace engineer at Princeton and a lawyer at Harvard, where he was an editor of the Harvard Law Review. Robert Pohly is the portfolio manager at Samlin Capital, an equity long-short fund, focusing on the financial, healthcare, and industrial sectors. Before Samlin, Rob was a portfolio manager at Sigma Capital and at Credit Suisse's prop desk. Before that, he was a financial services analyst at the fabled Tiger Management. John Bader is the Chief Investment Officer for Halcyon Asset Management, as well as that firm's co-chairman. John's been a portfolio manager for Halcyon's multi-strategy fund since 1991. Before that, he was a director of research at Grusin Company. Mr. Bader is also an old friend of the Roundtable. Not only did he participate in our very first symposium in 1996, but he also continues to make meaningful contributions to our best practices research. And the moderator of the Greenwich Roundtable today is Brett Barth. Brett is a founding partner of BBR Investment Management, a multifamily family office. He's also an active member of the Greenwich Roundtable's programming committee and has volunteered to tackle this very fluid situation. Brett?
Thank you, Steve. Thanks for the introduction, and it is an honor to be the moderator today. I was pretty excited to hear the topic, surviving on the down and prospering on the turn, and I would say as early as Monday or Tuesday morning, I was really excited to hear about prospering on the turn. Today, I'm more interested about surviving on the down, and hopefully by this afternoon, as Steve pointed out, it's only the last hour that matters. We'll be thinking about prospering on the turn again. Given how much we've heard in the last 2 years, a lot of very eerily correct predictions about the down, we obviously wanted each of the speakers to focus on their own predictions and thoughts on where we are, but we did ask everyone to lean a little bit towards the prospering on the turn and hearing a little bit more about opportunities, regardless of where you think we are in the cycle today, although we'd like to hear about that also. And fortunately, we do have a panel that is quite varied with expertise from credit to equity, fundamental long short, special situations, relative value, et cetera. So we have quite a bit to cover this morning. And so with that, I guess I'd like to turn it over to Steve, if you wouldn't mind being our first presenter this morning.
I'm going to try to confine my remarks this morning. Should I be using a microphone, by the way?
If you would, we're recording.
I know you said you wanted to record.
Yeah.
Slide this over here.
Please come back in a year and check how you've done.
I'm going to destroy the tape. All right. I'm going to confine my remarks this morning to the topic that we've been given. So I'm not going to address how we got here, why we got here, the merits of various remedial actions, both ongoing and proposed. Instead, I'm just going to spend a couple of minutes with thoughts about surviving the down, a couple of minutes on looking for the turn and how to see a turn, and then try to focus on three specific profit areas that I think are attractive coming out of the turn. So on the surviving the down part, I want to start with some reflections that are, I think, uncomfortable but true nonetheless, which is many hedge funds are not going to survive the current market disruptions and financial panic. Many others will survive, but will know in their hearts that they survived because of good fortune and luck. It'd be nice to think that at times like this we separate the wheat from the chaff and brilliant investors from the idiots. But I really don't think it works that way. I think that's what happens over long periods of time in functioning markets. It's undoubtedly true that some people will survive due to their superior piloting skills, but I think the reality is most of us that survive will survive because we were the fortunate ones who didn't board the wrong flight rather than due to some superior piloting skills. That said, it seems to me for a hedge fund business that the key to surviving is to be able to hold on to the important elements of your business model. First and foremost, being able to keep your own head. Second, being able to maintain the connection to the hearts and minds of your employees who work with you. The third would be your credit and brokerage relationships, and fourth, but also important, of course, is the relationships with your investors. For all of those relationships, it can't be any other way than that honesty and transparency would be critical to maintaining those relationships. Transparency is probably a popular topic here, but the reality is it's not a big thing in the hedge fund world, and that's because people are willing to put up with a lot of BS when they're making a lot of money. But this year, in general, they're not making a lot of money, and people's focus on understanding what's going on and understanding the risks they're taking, which can only be addressed by transparency and honesty, is clearly going to be heightened. The other final thing I'd add on this surviving the down is the way that Wall Street deals with hedge funds and that hedge funds deal with Wall Street is going to change dramatically, and I actually think this time perhaps permanently. I was very active in the markets in 98, and post 98 there were significant changes in the street's attitude towards hedge funds, which lasted for 18 to 24 months. And after that, things reverted to where they were. Due to the change in the structure of the banking and brokerage industry and the change in the nature of the government's involvement, I think we're going to see permanent changes, and we're all going to have to adapt our business models in a way that we didn't really have to do after prior difficulties in the market. I want to turn now to the question of how do you see a turn? People talk about, are they going to ring a bell? I wouldn't expect to hear a bell. And in fact, I'm going to suggest this morning that it's distinctly possible that the turn already began at least 2 months ago. And that really relates to the anatomy of what's going on in this crisis, which is this crisis has been a series of individual rolling tops in different markets stretched out over a long period of time rather than one turn from bull market to bear market. So if you really think back, the subprime market really peaked at the end of 2006 and started going down. The commercial mortgage-backed market peaked in the first quarter of 2007. Corporate credit didn't peak until basically June, July of 2007 before it finally turned. The U.S. equity market didn't peak till October of 2007. And we continue to have those series of declines. The municipal bond market really didn't get in trouble until February of 2008. Commodities continued to enjoy a bull market until June, July of 2008. And finally, the money markets didn't really run into serious difficulties until September of 2008. So you've had a series of rolling tops stretched out over the better part of 2 years. Given that structure, I don't think it would be that surprising if we had a series of turns in individual markets spread out over time rather than one big turn. And I think you could argue that that's already begun. In particular, the first market to turn down, the subprime and Alt-A mortgage market, appears to me to have made a bottom at least 2 months ago, probably sometime in July of this year. And subprime is the one market that in credit that didn't make new lows or new wides in spread last week or this week when everything else did. That bottom seems to have held. So we may already be in the process of a turn. Now I'm going to talk about potential profit opportunities. I'll start by saying that in our view, the fixed income markets have more potential and are more interesting than the equity markets now, although both are interesting. And I don't say that because I'm a fixed income guy, and if I were an equity guy, I'd say the equity markets are more interesting. We trade both markets, but the reality of what's gone on in a deleveraging-driven financial crisis like this, it wouldn't be surprising that the fixed income markets would see the greatest devastation and therefore perhaps the greatest opportunity set, and we think that's true. In addition, fixed income instruments, once they're valued reasonably, because of their cash flow characteristics and because of the pull towards par as they approach maturity, these features exert a sort of financial gravity that tends to keep these instruments in some sort of orbit. Although it could be a very elliptical orbit, they tend to stay in some sort of orbit, and that can be very beneficial and tends to make them be able to turn rather quickly. That said, I'm going to deal with three fixed income areas this morning. The first one, which is relatively obvious, since I mentioned earlier, is subprime and Alt-A residential mortgage-backed securities. Obviously, a lot has been said and written about these, and I don't intend to dwell on them or spend a great deal of time on them now. I'll just say that our interest in this market is not because we have a sunny outlook on the world. We've been negative on the economy for quite a while. We've been very negative on real estate for quite a while. We also think that the efforts that the government is making to address the residential mortgage problem could make matters worse in many ways by legitimizing and even incentivizing people not paying their mortgages. That said, the argument is very simple, which is all of that and more is already in the prices. And in particular in the prices of top of the capital structure, AAA, subprime, and Alt-A mortgage-backed securities. When we look at the cash flows that you're likely to see off these securities, we see 15% unlevered yields, even on very negative sets of assumptions, 80 to 90% cumulative default rates, severity 60% plus. You still pencil out to 15% sort of yields. In addition, to lose money on these securities, you would generally need 90% plus cumulative defaults and, more importantly, extremely high 70% plus severities averaged across the entire pool. Possible, but the asymmetry between the risk and reward in these securities is very significant. Also, interestingly, some of the steps the government is taking to try to prevent foreclosures and therefore defaults, although they could actually be negative for the market as a whole, are almost sure to be positive for the AAA senior capital structure securities. And there's a host of reasons for that, but basically what you find when you look at these securities is they're very insensitive to default rates. In fact, many of the bonds we buy, actually higher default rates will raise the yield on the bond because the recovery cash flows are directed towards the top of the capital structure bonds. Instead, what they are sensitive to is severities, how much is lost on defaulted mortgages, and in that area, many things the government is trying to do are actually likely to be helpful. The other two fixed income areas I want to address, before I get to them, I want to talk about a common feature that they share that I think is important in times like this. We all know that many cash fixed income markets, cash instruments, have been hammered beyond belief because of the lack of balance sheet financing. Because although they may look attractive, particularly on a relative value basis, and one can imagine all sorts of attractive trades, there's no financing, and either the trade can't be done unlevered, or on an unlevered basis, it just doesn't have an attractive enough return to really make sense. However, there are certain markets in the fixed income world that, due to unique trading structures that exist in those markets, make it possible to get synthetically long cash assets with significant leverage even in the current times. I'll mention three of those markets. The first one, which is the most obvious one, is agency mortgage-backed securities, where the TBA market in agency mortgage-backs continues to function reasonably well, and therefore you can still get long agency mortgage-backed securities with substantial leverage on an off-balance sheet basis. The other two, which I am going to talk about in more detail, are the tax-exempt bond market where it's still possible to get long via the MMD index swaps. And finally, the AAA commercial mortgage-backed securities market, where index total return swaps still make synthetic longs possible. So these are markets where the cash instruments have been beaten up because of the lack of balance sheet, but where it is in fact possible to get long those cash instruments without consuming as much balance sheet. So let me talk about each of those and then I'll be completed. Tax-exempt bonds. Almost everybody has some inkling of what's happened in the tax-exempt bond market. Just to put some numbers on it, if you look at medium to long-term AAA large state general obligation tax-exempt bonds, they are trading with yields of 1 to 1.5% above the taxable swap curve. For a taxable investor in the U.S., individual investor, this turns out to be 4 to 5% above taxable bond rates on on a tax equivalent basis. So huge spread. Obviously, like almost everything you're going to hear about this morning, levels that haven't been seen before. There's a couple of interesting aspects there, though. First of all, this is not a credit thing. I would argue with anybody, and I think win, that perhaps after treasuries and agencies, large state general obligation bonds are probably the safest securities in the U.S. fixed income market, and they ought to be viewed as safe havens rather than credit problems. That doesn't mean there won't be substantial defaults elsewhere in the municipal market, revenue bonds, various project financings, insured bonds, but AAA underlying state GOs are the kind of credit that people ought to be seeking at times like this rather than trying to move away from. So it's not about credit. It's certainly not about tax rates, which I think everybody would agree over the next 10, 15, 20 years are more likely to be higher than lower. What it's about, like a lot of things going on today, is technical meltdowns in the infrastructure of the market. In munis, we saw that in the auction rate market in February, which didn't melt down, it just went away completely. And we're seeing substantial pressure, particularly in late September, in the variable rate demand note market. These are the underpinnings of a lot of what goes on in the tax-exempt market and has affected the whole market and created a technical opportunity that we think is quite unique. Last, I want to talk about what we think is the most attractive high-quality fixed income asset out there right now, which is AAA, top of the capital structure, commercial mortgage-backed securities bonds. I assume most of you are familiar. We're not going to do a primer on CMBS. Here, I would just say that in some ways it's similar to subprime and alt-A bonds in that a pool of mortgage loans is assembled and then cut up into tranches of varying maturity. The tranches have in some ways similar cutoff points, like the most senior AAA tranche is 30 to 100. The only thing I'd add to that, though, is that's about where the similarities end. The underlying structure of lending and the markets is vastly different in commercial mortgage-backed securities than in subprime or alt-A. There's no teaser rates. There's no low doc loans. There's no doc loans. There's really, in these pools, no floating rate loans to speak of. The structures tend to be simple. You tend to have bullet maturities. The average loan size is, of course, many, many times the typical loan size in residential. So there are vast differences in the market. That said, the senior bonds, which sit at the top of the capital structure with typically 30% subordination, we think actually do deserve the AAA ratings that were attached to them. Not everything in CMBS land does, but these bonds typically had two large AAA classes subordinate to them in the capital structure. There's, I think, some real question about some of those AAAs, but we think the super senior deserve their ratings. That said, those bonds trade right now at a yield to maturity in double digits, 10, maybe 11%, depending on where we're trading this morning. And what we think is they're a great platform because there's a lot you can do with them depending on your view about commercial real estate. If you don't have any view at all and you just want a relative value trade, buying commercial mortgage-backed securities and hedging them with credit default swaps opens up a basis that's in the neighborhood of 300 plus basis points between the CDS hedge and the bonds. Now, there are a lot of basis trades out there, right? Corporate bonds, high-yield bonds, almost every cash instrument, as we talked about earlier, tends to trade cheap to its underlying derivative because of balance sheet issues. The difference here is that there's financing available. You can buy the bonds through total return swaps. You can get very substantial leverage, and you can get it for term. Easily 6 months, if you press maybe even a year, locked in leverage at a time, which makes the basis much more exploitable than in many other markets. On the other hand, if you're not a super bear on real estate fundamentals and you don't believe we're going to have a commercial real estate depression, there's a pretty good argument for just buying the bonds outright. Yield to maturities of 10 to 11%. Holding period returns, if you assume that in 2 years we might be able to return to levels we were at a few months ago in commercial mortgage-backed securities, you can easily be looking at 20% plus unlevered IRRs with an ability to lever them. And then finally, if you are a super bear on real estate, there's opportunities to use these bonds in those kind of trades, we think, also. So you can buy AAA and you can short the mezzanine tranches of CMBX and essentially create a very large amount of upside to real estate defaults with positive carry along the way. I just want to finish with a quick disclaimer about all of these ideas, and that is that they can be hazardous to your short-term financial health and maybe your long-term mental health. And that's just the nature of what we do. We're long-term, value-oriented guys in the multi-strategy world who are willing to sit around and wait out incredibly painful mark-to-market moves. We believe that these trades have extraordinarily high probability of producing attractive returns over the long run, but offset with that is a certainty of producing mark-to-market swings like you wouldn't believe along the way. And that is essentially the trade-off the markets are offering us in many opportunities now, and that's certainly present in these trades. Thank you.
Thanks, Steve. One quick follow-up question before we move on. I like your idea of rolling tops and rolling bottoms, and clearly the tops are caused by balance sheet issues that then cause a sell-off. You've seen this bottom, or we think we've seen this bottom in subprime. What do you think the conditions precedent are for the bottoms, and what are the signs to look for to find bottoms? And the tops that we've seen, how do we find the bottoms in each of those asset classes going forward?
Well, a difficult question. What I would say is since many of the moves start out fundamentally driven but then turn into supply and demand related problems, you really have to look at the supply and demand factors to find the bottom. What made us think even in early August that we may have seen the bottom in subprime, for example, is two things. On the supply side, it appeared to us that essentially most of the people who had to sell had already sold, and you were largely left with holders who either didn't need to sell and recognized the value or basically couldn't sell given their situation, and that produced some relenting in the volume of sales going on in the market, at least at prices that were prevailing then. And then on the buy side, given the current environment in many instruments, you need to see compelling value for unlevered, non-traditional buyers. And it appeared, because all the traditional buyers are tapped out of buying capacity, if they're even around, long before you see the turn. And so it seemed to us in subprime that as the yields began to hit 15% unlevered, that the opportunity became compelling for a lot of non-traditional players. And that combination of slower selling and a new group of buyers seems to have stabilized that market, albeit at incredibly low prices.
On the topic of surviving the down and prospering from the turn, I first want to just talk about portfolio construction and how we think about that to survive the down, and then talk about a couple of ideas that we find interesting today. As far as portfolio construction and surviving the down, I think that it's imperative during these times of volatility to have a well-diversified and liquid portfolfolio. And that's not so much to be able to increase or decrease your gross if you see a turn, but more to replace good ideas with better ideas. And I think that a lot of hedge fund managers over the years have gotten more concentrated in their portfolios. As returns were tougher to come by, we saw two things: concentration in portfolios and increased leverage. And I think that both of those, we've heard a lot about, increased leverage and all the problems that's caused, but a little less about concentration. And I think that both are things to keep your eye on and to protect against. And the reason why a diversified portfolio is imperative in this time is that every time you think you have a good idea, next week there's a better idea. And if you're stuck in a particular idea or asset class that, today you think is just a great risk reward, and you can't replace that with another idea that might come up down the road, you're really handcuffing your ability to be flexible in this market, which I think is key. So an example of that, I think, for us recently, we are primarily a long-short equity fund, and we've stayed away from all fixed income instruments up until recently. And again, in a diversified portfolio, I think it does make sense. As Steve said, the opportunities in fixed income are extremely attractive. But to have some exposure to what's going on in fixed income within your core competency. So one area that we do focus a lot on is financials. And recently, the senior debt for regional banks has just completely fallen out of bed. And I think it's really a combination of a couple of things, but primarily the recovery rates in the bankruptcy of Lehman Brothers and Washington Mutual. And I think for the regional banks, it was Washington Mutual in particular. When J.P. Morgan bought Washington Mutual, it set a different, it was a different type of merger that no one really thought about in the fixed income world. They didn't buy it outright. They did an asset purchase. They purchased the deposits and some of the assets, and they left the debt behind. And by doing so, J.P. Morgan created $13 billion of equity. And the FDIC, was able to, go to the newspapers and the politicians and said, "See, we've saved the depositor, we saved the taxpayer. It cost us nothing." When in reality, it actually cost them a lot more, because as a result of the way that deal was structured, the senior debt and all debt of regional banks completely fell out of bed. I think that the Wachovia situation was a direct result of how the J.P. Morgan Washington Mutual deal was structured. And literally the next day after the J.P. Morgan deal was announced, Wachovia's senior debt traded down 30 points immediately. I think that that's where the opportunity is, and the question is timing. Why now? Why couldn't it get worse? And I think you have to look to what the government is doing and how the government is responding recently. And it's really a shift. It's really a complete shift from how they handled the Lehman Brothers and the Washington Mutual situation. The first evidence of the shift was, some of you might have seen it, but it was a little bit arcane, is they changed how the accounting works for a stock-for-stock transaction in a bank deal. So they allowed banks, an acquirer bank, to purchase a distressed or troubled bank and immediately record a tax benefit and use all the tax benefit once you write down the loans. And this is significant. I mean, and some of you might have seen this. This is really what brought Wells Fargo back to the table to buy Wachovia. And we, just for giggles, we went back and said, okay, if Jamie Dimon could do it all over again, how would he have structured the WAMU transaction? And the answer was interesting. He would have had to raise an additional $2 billion of equity, but in return for raising that $2 billion, he would have recorded a $9 billion deferred tax asset that he could have used to shield earnings for the next, 3 to 5 years or whatever, however long it took him to use that asset. So I think if Jamie had to do it all over again, he would have, instead of leaving the debt of Washington Mutual behind, he would have assumed the debt of Washington Mutual. So Washington Mutual senior debt would have, which is now trading at 2 cents, 3 cents on the dollar, would have been worth par if he had the benefit of that tax law change, which he didn't have at the time. The second thing, so in short, the government has made it much more attractive for an acquiring bank to buy the whole capital structure of a target bank rather than structure a deal like Washington Mutual. The second thing, the second factor relates to the TARP program, which I think a lot of people on the buy side poo-pooed as really not going to do much. And it's our view that it's really not going to do much to save the economy, but it has significant ramifications for the banking sector. The direct equity infusion, just to throw some numbers at you, the government is, as most people in the room know, is going to inject $250 billion of a preferred security with some warrants attached. They did half of that, $125 billion, with the top 9 banks. So they have another $125 billion left. That $125 billion, and we ran the numbers yesterday, is enough capital. If every single bank decided that they wanted to, receive this preferred equity, it's enough capital to boost the regulatory capital of every bank in this country by 20%, which is not insignificant. And that will boost, tier 1 ratios from anywhere between 7-8% up to the 9-10% level. So we think that's a significant positive for the senior cap structure of regional banks. The second thing, or the third thing rather, that is an extreme positive for the top of the capital structure of regional banks is the liquidity facility that they put in place. So any regional bank who issues debt, or any bank for that matter, not just regional bank, that issues debt between now and June of 2009 can pay a 75 basis point guarantee fee for the government, and that debt is guaranteed by the U.S. government. So, if you were Morgan Stanley and your debt was trading at 60, 70 cents on the dollar, and you had a lot of debt maturities coming due, this is a significant positive. So, so you look at how the government was responding and how they handled the WAMU and the Lehman situation, and now they're doing everything they can to attract capital to the fixed income markets to protect the top of the capital structure, and I think that's significant. And regional bank debt is still trading with yields of anywhere. We were buying a couple of last week or so. We were buying regional bank debt with yields of 35 to 50% yield to maturities for relatively short duration paper, and that is that's attractive. And these are unlevered returns, so that's equity for us who look for equity-like returns. That's a really interesting risk reward. So we actually sold some of the equities that we were long and went up the capital structure a little bit. The other area within financials that we're doing that we find interesting right now is less talked about because there's just so much news is the property and casualty sector and the implications of the downfall of AIG and what that might mean to the property and casualty sector. Property and casualty stocks, like most stocks, especially most financial stocks, have gotten just drummed. Many names are trading below tangible book value. For the higher quality, well-known names, they're trading maybe a slight premium to tangible book value. There's a lot of concern about the assets that are in an insurance portfolio. Property and casualty companies, as opposed to life insurance versus life insurance, have much safer investment portfolios. They're shorter duration. So start with valuation, which is great, but everything's cheap. So why is it interesting? One, AIG represented 12% of the property and casualty insurance market That premium, whether or not they survive, I'm not sure, but that premium is going to get redistributed throughout the industry to some degree. Maybe it's half, maybe it's all, but AIG will lose a lot of market share. That market share will be picked up by the remaining players in the industry. Second, the absence of AIG and the relatively poor investment returns is enough to halt the downward movement in insurance pricing and potentially actually cause a turn in the market, turn in insurance pricing. So you have a very interesting dynamic of companies that are trading below tangible book with relatively safe investment portfolios where pricing is about to turn. So we think that that's a very interesting area and very positive risk return.
Great, thanks. Surviving the down and profiting from the turn. That, of course, is predicated on there being a turn. But we'll get to that. And that shouldn't let you think that perhaps I'm not optimistic about one's ability to make money both during the down and during the turn. Let's take the next few months first. We're clearly in the greatest credit meltdown since the Great Depression. And from a long-term point of view, there are incredibly compelling values in the credit markets. Today, one can buy secured debt that should be well covered under even the most dire of circumstances and achieve equity-like returns. But I'm not doing that right now. At the same time, many individual stocks look incredibly cheap. But cheap stocks can get cheaper. And over the next few months, in the face of swap unwinds, hedge fund redemptions, and so on, who knows where they trade? I'm not doing that either. Rob pointed out that it's wise in a market like this both to be liquid, and it's also wise not to be overly leveraged or concentrated or what have you. But I think in a market like this, during the down, you can not only survive, you can prosper by not taking strong points of view about the market. We're living in a very uncertain world, and I think the single biggest mistake that investors are making today is trying on a daily or weekly basis to say where we are. 2 weeks ago, a lot of smart people might have said, gee, I'd be shocked if it's not not only a very deep recession, but it could take 3+ years. How much money is the government going to infuse? The government infuses enough money, and I don't know what that number is, forget $700 billion, it could be a much shorter down. So in the context of right now, what I like are arbitrage strategies where I think I have very little risk. At times our book as much as 85% equities, at times as much as 85% credit. Right now I'm focusing on arbitrage strategies. Specifically, within the merger space, I think there's some truly extraordinary opportunities. So take a big deal like InBev's acquisition of Anheuser-Busch. In that deal, you're supposed to get $70 in cash. Well, it's pretty easy to value the $70, assuming you're going to get it. I'm going to get $70. I can count that. Last night, the stock closed below 61, and this deal theoretically should close by the end of the year. So you're making $9 on under $61. And actually, that's a funny aside. I think the close was actually 60.80. And in the old days of arbitrage, I'd be counting those cents. But when you can make $9, I don't even have to count the cents. So you got about $9 up. And we could sit and we could debate what the downside is. Before the deal, the stock was trading around 50. So some people might say, gee, from 61, there's $11 of downside. Back in January, the stock was, $46. If you use that number, you'd use a bigger number. But whether it's 1.5 to 1 or 2 to 1 or 2.5 to 1, by normal arbitrage standards, the risk rewards are off the charts good. Now, what's shocking to me is when you mention this kind of thing, even to some sophisticated hedge fund managers, they say, yeah, but, in this market, can't there be a material adverse change? Sure, there are financing commitments, but what about the material adverse change clause? Let's go to the videotape. See, the funny thing is the current spate of deals that were announced in this environment were all announced when people were worried about material adverse changes. So I'm going to read you some of the things that are not a material adverse change in this contract. Number 1, effects resulting from changes in the economy or financial, credit, banking, currency, commodities, or capital markets, generally in the United States or other countries in which the company conducts material operations or any changes in currency exchange rates, interest rates, monetary policy, or inflation. They say, yeah, but what if there's a war or terrorism? So let's go to number 2. What else is not in the material adverse change clause? It's not a material adverse change if you have an act of God or other calamity, national or international, political or social conditions, including the engagement by any country in hostilities, whether commenced before or after the date hereof, and whether or not pursuant to the declaration of a national emergency of war or the occurrence of any military or terrorist attack. Most of these contracts, if the whole industry goes bad,
What's that leave?
That's not a MAC either, right? So
What would be a MAC?
A company-specific MAC. The good news is there are an awful people drinking a lot of beer in this environment. But the fact of the matter is, if there's something that happens that affects the whole beer industry, and it's not specific to the company, that's not a MAC either. So it has to be somehow or other people have to suddenly develop a really bad distaste for Budweiser. So the amazing thing is that, assuming this closes by the end of the year, and it could close before that, you're talking about in excess of a 70% annualized rate of return. Now, what could go wrong? And by the way, before I even go there, Anheuser-Busch is not unique. I mean, whether it's Schaeffler's acquisition of Continental in Germany, or Tecumseh's acquisition of Fordings in Canada, or Ashland's acquisition of Hercules, these things are all close to triple-digit returns with contracts like this. I mean, the numbers are kind of extraordinary. And I don't have to worry so much if the market's going to go up or markets go down. What do I have to worry about? What I worried about a lot over the past few weeks was, even if the banks were hooked in these contracts, what if they didn't have the money to fund? But now I've got the G7, and actually what I would tell you is a couple of weeks ago, we were spending a lot of time underwriting the banks effectively who were funding these transactions. We're saying, who's in which bank group? And are those banks going to have the money? Well, now that the G7 and our government are out there backing these banks, I think these deals are going to close, and I think it's not only a way to survive the down, but it's a way to prosper. So what about the turn? Well, the funny thing about the turn is that it's very hard to say exactly when this turn, so-called turn, is going to happen. But I think the first thing you have to do is to make some big picture observations. I talked about how a lot of stocks were cheap by historical standards, and they are, and if you buy them for the long term, I think that there's lots of money to be made. But really what this crisis has been about is it's a credit crisis. I mean, this is the greatest credit crisis in our country since the Great Depression, and so I think that if I can achieve equity-like returns from credit instruments, and in particular from secured instruments, that is more interesting to me right now. Later, after we've bottomed and we're on the way up, maybe I want to make money in subordinated debt or converts or equity or what have you. But after the next few months, I want to focus on credit. Now, before I go there, I should say one thing. Well, if these arbitrage situations are so good, why don't I keep doing that? The answer is that's going to be over in the next few months. What we're talking about is these existing definitive agreements with contracts, with committed financing. There's no financing for new deals. So this is a very good, interesting, survive the down kind of business. It's not good a few months down the road. Now, in terms of credit, I'd like to make a couple of big picture principles that I've always liked to kind of live by. The first principle is it's generally safer to get long credit after default rates have peaked. I'll say it again. It's generally safer to get long credit after default rates have peaked. Now, it's different if you look at, say, the 1990-91 period versus the 2001-2002 period. In fact, if you bought before default rates peaked in the prior period, you would have made a lot of money, whereas you would have gotten crushed in the second period. And the reason for that is pricing, and one exception to my little rule is if prices are cheap enough, which I think they are now in many ways, you can actually buy before the peak. But if you're going to buy before the peak, you're really best off staying at the top of capital structures. There's plenty of time once it's very, very clear that defaults are on their way down as opposed to they're on their way up, that you can actually get long, more subordinated instruments. But when do defaults peak? Well, defaults peak typically once the economy is already swooning or has swooned. One of the things people get a little tied up in their underwear and they say, well, it doesn't have to do with leverage ratios and this and that. And sure, higher corporate leverage typically means more defaults. But the fact of the matter is that more than any other variable, it's all about GDP. I tell myself, it's the economy, stupid. So the fact is that until the economy's really further in the toilet, you're not going to see peak defaults, and indeed you haven't. Now, we could talk about how this cycle, defaults may be different than the last cycle because you have more covenant-light instruments and more capital structures are weighted to bank debt versus high yield or what have you. But at the end of the day, defaults are not going to peak till the economy's worse. Remember, we were still 2.8% positive GDP in the second quarter. I think we're clearly in a recession now. I personally think it could be quite deep, and it has the potential to be quite long absent adequate government infusion. But the point is we certainly haven't peaked yet. So I've dipped my toe in the water, but I'm not yet buying aggressively. So let's talk about different credit instruments, though, that are going to be interesting over the next few months and where I think there's money to be had that I really think is analogous to shooting fish in a barrel. So bank debt, first of all. One of the reasons I'm not buying so much yet, by the way, is also liquidity and also the rating agencies, and we'll come to that. But right now there are a lot of bank debt names priced in the 70s and 80s with interest rates between LIBOR plus 150 and LIBOR plus 350, oftentimes with LIBOR floors, which I think are going to look awfully sexy down the road. I mean, Wrigley's, for example, has a 300 over LIBOR floor, which typically translates into double-digit returns. Many of these companies are not cyclical. They have debt to EBITDA of 4.5 times or less. They have debt to EBITDA less capex of under 6 times. So I don't think there's a lot of principal risk, although there's one fallacy in this, and I think it's worth noting. If you look at a chart which shows you corporate leverage defined as debt to EBITDA for leveraged issuers, it looks like you're only half a turn more leveraged through the capital structure if you do this on a rolling basis since you were in 2002. We don't look that much more leveraged. The fallacy to this is the economy is just swooning. No doubt revenues and margins are going to face declines. So you got to be careful issuer to issuer and make sure that once the EBITDA does get crushed, that you still have adequate enterprise value to cover your obligations. But I think there's some really easy ones. You also have easy ones by way of note right now in some of the shorter-term arbitrage situations. So, for example, in the M&A space, you have it on the debt too. Alltel has bank debt trading at 93 cents on the dollar. Verizon is buying Alltel. It's got the contract that's not conditioned on financing. It's got a bulletproof contract, like I said. But this one's a little funny because, unlike these other deals, it's not yet clear how Verizon is financing this transaction. You just know they're hooked. And they're hooked to the tune of $28 billion. And a lot of people say, oh, my God. But they got to take out the bank debt, assuming they can get this thing financed. And the interesting thing is that Verizon has an $85 billion market cap. Verizon Wireless has debt capacity. There's cash in the holding company too. Verizon could sell stock. There's a lot of ways they could do it. They're hooked. But meanwhile, the bank debts of Alltel is 93 cents on the dollar, so you can make 7 points plus the spread over LIBOR between now and the end of the year. It's fat there too. That's really a pre-turn thing, but worth noting. So why not go very long bank debt right now if the names are so cheap? Well, I think the technicals are incredibly ugly. Some 30 market value CLOs hit triggers in the past couple of weeks. I think a number of those may well manage to be recapitalized, so it's not a whole $12 billion that floods the market. You've got hedge fund redemptions. You even have the likes of GMAC putting bids with indications in competition on the table for revolver bank debt where they clearly didn't want to put up that much more cash. You've got financial institutions deleveraging. And perhaps most important, if the rating agencies decide to get feisty, it could be a tremendous problem because it could lead to the unwinding of a lot of cash flow CLOs. I don't know whether they'll do that. I think there are pressures both ways, and I can make strong arguments both ways, and there are a lot of smart people who will argue both, but there's a real risk of that, and if that happens, stuff may get cheaper. In addition, you've got total return swaps that are getting unwound. People have to post additional collateral as the market comes down, and moreover, as certain hedge funds hit NAV triggers or other institutions hit NAV triggers, those may unwind. So there are a lot of technical pressures in the bank debt market. What about high yield stress debt market. I generally like secured high yield better than bank debt today, just because of, number one, the better liquidity and the fact that there's arguably a less bad technical overhang, although to be sure it's getting shellacked as well. High yield spreads went to 12.78 over treasuries as of last Thursday, according to the CSFB index. It's a little worse than that now. In a historical context, that's incredibly cheap. That's a bigger spread than in each of the last two down cycles. It's a great time to buy, but I'm going slowly in the face of swap unwinds, hedge fund redemptions, and mindful of the fact, again, that defaults have not yet peaked. Distressed asset-backed. I think there are tremendous opportunities in distressed asset-backed. Steve talked a little bit about that. We tend to like to buy into relatively non-economically sensitive industries where the paper is seasoned and where, in addition, the rate of default for the structure has likely peaked. Classic distressed debt investing. This has been one of our core competencies over the years. I find it kind of amusing. Enormous numbers of sophisticated investors are saying, so now you're doing a lot of distress, classic distressed, right? Well, when I think about classic distressed, I think about buying debt of companies that are in bankruptcy, or if not in bankruptcy, that imminently are going to do some kind of debt recapitalization. Well, guess what? They haven't gone bankrupt yet. I mean, the market, the prices of things are down, but I think this is going to be a tremendous opportunity in the coming year. The supply should be enormous. We are seeing some opportunities because some traditional distressed funds are spitting up blood. But generally, I wait for the bankruptcy, and I want to see how many claims come in before I get invested. So this is an opportunity that's coming. Real estate debt, Steve talked about a lot of the debt pools that I think are attractive, so I won't go there. But I think there can be tremendous opportunities to buy individual mortgages. Over the past few months, we've looked at a number of these, and every deal looks the same. You're looking to buy some piece of mezzanine debt where it's all predicated on a bunch of asset sales that may or may not happen, sales of units of whatever flavor of real estate it happens to be, and that might be offered at 50, and you say, well, where can I buy the first mortgage? And they say, well, that's par. Well, I think over the next number of months I'm going to be buying those first mortgages cheap, and that's what interests me. I have no interest in the mezz. People ask me a lot about converts. I have no interest in converts right now. It goes into the same. Arguably, they should be interesting because people have lost their financing and the prices are down and so on. But basically, at this point in the cycle, I'm not interested in buying unsecured debt, whether it's converts. I'm not interested in buying preferreds. Before defaults have peaked, I think it's very dangerous to buy things other than secured debt, which still can get cheaper. Coming out of the cycle, each of those other asset classes gets interesting. Ultimately, post-bankruptcy equities get interesting, but I think it's too early. Right now, a lot of people also ask me about capital structure arbitrage. Don't like that. I think that I have a basic principle that after the high-yield market has already cracked, playing capital structure arbitrage, unless you have a specific value realization trigger that's imminent, such as the filing of a bankruptcy if you're long-term paper and short-term paper that trade on top of each other in a bankruptcy, or the exiting of a bankruptcy. Absent such a trigger, I think it's fraught with danger buying in a market like this, particularly with short squeezes being rampant at the moment, a CDS market that's filled with counterparty risk, and so that doesn't interest me much. Bottom line, mergers over the next few months. As that book rolls off, I'm interested in buying bank debt and other secured debt, stressed asset-backed debt, classic distressed investing as the year goes on, and up the capital structure to follow. Thank you.
Thank you, John. Wow, we really did cover the waterfront in terms of a lot of really different ideas and really interesting. Thank you. You guys did a great job not only meeting, but I think beating expectation on the investment ideas side. I actually wanted to kick off with the first question on the surviving the down and prospering on the turn theme, but more related to your businesses specifically. Steve alluded to that when he kicked off, and I hope I never use the what plane you board versus how you pilot the plane analogy with any of my clients, and hope we don't get there. As it relates to your businesses, though, Steve, you alluded to how you deal with prime brokers, and for all three of you, in terms of how you deal with clients, how you structure your business, how you structure high watermarks, how you deal with LPs. As you think about your businesses as businesses surviving the down and prospering on the turn, what have you learned in the last couple of months? What are you learning through this redemption cycle? And what would you change about your business? How would you structure it today if you could do it all over again, given what you know now about trying to survive this downturn in the hedge fund industry? Why don't we start with you, John? We'll just work down the row.
Sure. Happily, the way we've structured our business, I think, has worked out pretty well. There's one thing that we have in some of our older partnerships that I actually think is a good thing, and it's not going to affect our ability to survive, but I always explained to investors this was a good thing, and because they didn't see it that way, most of our newer partnerships don't work the same way. And that is that we had a high watermark that effectively was a one-year high watermark. And the argument is we're willing to work for free for a year, but it's in your best interest to have us be able to continue to attract the right kinds of people and so forth. In some of our older partnerships, we actually have such a thing. And people wanted to crucify me about this at some point in time. And it's sort of funny because going back to 1991, this year aside, with our worst year in our flagship fund, we're down 1.8%. It wasn't like it was but the point is that the argument was, look, if you make people that much money over that many years, fine, you work free for a year, but you want to be able to incentivize people. I actually think this was a good structure. And it's funny because I was meeting with an extraordinarily wealthy family who came in with an advisor, and the advisor picked up on the document and was about to lace into me, and I said, I really genuinely view this as for the investors' benefit, although I know no one seems to look at it that way. And the interesting thing is that I said, this is what, was awfully painful for the likes of George Soros and Julian Robertson, and the client looks at the advisor and says, I liked it when we were invested with those people. This is a good provision, which is sort of an interesting thing. But I crucify me if you like. I actually think it was a good structure, and there you have it.
Okay, thanks. Steve, any additional thoughts?
The thing I would add, so one thing that we have done that I think has worked really well is we always marketed the fund directly. We never had intermediaries, and we always met face-to-face with investors on a regular basis, both before they invested and afterwards. And I think having those kind of direct relationships where we believe that every investor in the fund actually understands what we do and the risks that come with that have made a huge difference this year. We know, I have many friends in the industry whose performance has been no worse than ours or better than ours, that have faced substantial problems with their investor base. And I think it's largely because of the fact that their investor base were basically casual investors. They made a casual decision getting in, and they make a casual decision getting out. And I think going forward, everybody's going to realize that that's a dangerous way to build your business in the hedge fund business. On the other hand, in terms of things that we've done that maybe in hindsight I wish we hadn't done, we spent a lot of effort over 15 years structuring what we view as very favorable relationships for us with the banks and brokerages that we deal with. And that took a lot of effort on our part and was a big distraction and I had some benefit over the years, but I think in the end is going to turn out not to be all that beneficial because in today's environment, all of that is going to get changed anyway. And frankly, all of the people that we built the great relationships with are going to get fired, and we're going to have a whole new set of people. And so we may have invested more effort in that than we're likely to look in hindsight as having been worthwhile.
Okay. Well.
Our fund's a little over a year and a half, and I think one thing that we did right was lockup. When we launched, we had a 2-year lockup. So I think what that did was not so much force people into the fund for 2 years, but it really, it did that, but it it made people who might have been those casual investors shy away. We were, when we launched the fund and someone said, well, I can't do more than I can't do a 2-year lockup. I was like, whew, good. We're not wasting any more time. I think that was a positive. Second, growing too fast. I think that a lot of hedge funds have grown very, very quickly. And what they didn't realize was that money can when you have a lockup, when you grow quickly, that means on the back end that money can leave quickly. So we had a few different openings, and for each one of those openings, we took a lot less than what the demand was. Primarily because we wanted to just make sure we had the investment ideas to invest that capital, but also to make sure that we didn't have a flood of money that could leave on the back end. I think, John, to your point, high water marks and modified high water mark or 1-year high water marks are, they're interesting. We don't have one, but you really have to, sit down with your investors and do what's right for them as well as your fund. And there's a lot of debates on that, and we're sort of undecided.
Great. Let me turn it over to the audience, see if anyone has any questions. Yes, sure.
John, you alluded to the counterparty risk in CDS. How big is that risk?
Well, right now I don't have any CDSs, and I had a lot of them. So the answer is, for me, it's not big at all. I think that the scary part is you look at a lot of big financial institutions, and they theoretically have matched books, but if it turns out obviously the counterparties fail on one side or the other, that's a big problem. And it's really kind of there's a kind of perverse irony in it, and it's heads I win, tails you lose for the failed institutions, because they reject the bad contracts and take the good ones and say, thank you very much. I do think that, in large part, the government's desire to put money into banks was in part very much to alleviate what was a very scary problem. I don't think it was just about encouraging lending. It's kind of funny. I mean, it hasn't encouraged lending. You look at the Ted spread, and that hasn't moved all that much. But I think a lot of these big financial institutions really were exceedingly nervous, and so I think the risk was real. I think it's substantially mitigated because of these government infusions, and there may be more. And I think it's something the government's focused on. I think that I hope that it's a problem that can be dealt with, as opposed to one that the impression I get, for what it's worth, is that the Fed thinks that this is a big problem, but it's a dealable problem, more dealable than it's easier to deal with than some other problems.
Steve, let me ask you to answer that question as well. You alluded in your presentation about how you're able to get leverage through derivatives, swaps and CDS that you couldn't get in the cash market. So clearly you actually do have a lot of CDS or swaps on in your book today.
Yeah, we do. So there are really two parts to counterparty risk, and one of them is overrated and the other one I think is underrated. And John really touched on that. So the first risk is that the guy you have the swap with won't pay you. And I think that's actually an overrated risk, and in the short run. And the reason is because most of us deal with the street in a two-way mark-to-market margining basis on a daily basis. And the reality is when a counterparty goes away, the value difference that you face tends to be relatively small. And we just experienced this with Lehman. The second risk is what lawyers, I think, would call consequential damages. And that's a significant one, and we experienced that with Lehman too. And that is, if you're using a swap as a hedge for a position, and the swap count, let's say, was with Lehman. So Lehman files Chapter 11. That's a termination event and a default event under your ISDA. So you terminate all their swaps, and you're holding collateral from them approximately equal to the market value of the swap. So superficially, everything looks okay. The problem is now you don't have a hedge anymore, right? Because that swap was hedging something, and in most of the time, that wouldn't be a big deal, right? Because you just go out and do the swap with somebody else, and the difference between where you put it on and where you had it marked is additional damages, and it's your claim against Lehman. But the reality is you don't face this issue when markets are functioning. You face this issue when markets are not functioning. And I think the street as a whole found the process of trying to replace the hedges that they had on with Lehman as somewhere between messy and impossible. And so that people ended up with significantly more exposure to the Lehman failure than they would have expected because of the fact that they had such difficulty re-hedging positions that were hedged. So that is a big problem. That said, the reality of the world now is, people may disagree. I think the federal government has decided that the remaining core large group of banks is not going to fail, and in the U.S. and therefore I think that we're not going to see a Lehman times 2 event. Could have happened, but I think that's probably a risk that's largely passed out the other end of the tunnel now.
The other risk, if I may point out there, which is not so much a risk, but it's a problem from the point of view of a hedge fund manager. I had a fairly decent size CDS book, in every one of which instance, with one exception, I was long protection, basically to hedge credit longs. And in one instance, I was short protection, and by some miracle, every single one of my positions was profitable, and basically because everything went down and I was long protection, and my one short was a good one. And here I was. I decided, okay, now what I want to do is I want to see what it's like to start taking some of this stuff off. And when I actually went to do that in any kind of size, it was so far away from what I was getting quoted, and I just decided I really didn't like the game, and so I sold all of these things at a profit, but much less of a profit than if you called and got a quote. And maybe somebody would trade $1 million or $2 million where they actually gave you the original quote. So I mean, it's funny. You could say, oh, just transacted where they said, but then go try to do $10 million, and it was really not. It was sort of frustrating, and I'm very happy to be done with them.
Yeah, John, I just would add. I mean, the liquidity in that market is so bad. And the amazing thing is that we as equity investors look to that market as well. And you watch Morgan Stanley CDS blow out 300 basis points, and you're like, oh my God! But I think equity investors fail to realize that if you go and try to buy $100 million of protection on Morgan Stanley, you could blow it out 300 basis points, and the stock will trade down 50% on that. So it is. The CDS, I don't know how it's all going to play out, whether or not it's going to trade on an exchange, whether or not liquidity improves, but I think that equity investors looking at CDS has exacerbated the fears and problems for sure.
Now, I'd like to come back to the municipal market, because a lot of people seem to think that there aren't going to be changes there, but what we're hearing is that different views of police power under Chapter 9, the imposition of gap accounting for municipalities, the very real pension problems that some highly rated states have, which aren't going to get better in this market. Then do you see some material risk? A lot of these states have tax systems that are highly levered to asset appreciation. Do you see some risk that even if these are not going to be credits that are going to develop problems, that the idea of large municipalities or municipal entities as being gilt-edged AAAs is likely to come under question or take a hit in here?
So in this day and age, it's hard to answer any question that starts, do you see some risk, with the answer no. Yes is always the answer to those kind of questions. That said, I think that as you move away from large state general obligation bonds, the market is fraught with problems and is not immune to some of the excesses that existed in every credit market over the last 5 years. And so I guess you have to view all these markets on a relative basis. That said, we actually don't see an issue with AAA state GOs. These tend to be large states with very large taxing power. See, municipalities are different, right? You can hollow out in a city, and a city can, businesses, fleets can move from the city to the suburbs, and you can lose taxing power. And you can certainly do that with states along their border. New York would be an obvious one between where we're sitting and New York City. But But in the center of states, that really is not something that can happen in any reasonable period of time. The tax base tends to be actually quite stable, and the ability to service the debt is there. The other thing I would say is most of the AAA states, their fiscal position is actually quite a bit better than you might imagine in terms of most states have learned from the past and have built rainy day funds, and in many of the states those funds are very large, and so they're sitting on actually substantial assets. And in almost every state, the pension plans are funded to at least some significant extent, and although there could be long-term demographic issues with those kind of plans, those tend to be very long-term issues. Those are not the issues that are driving 10-year munis around these days. So yes, there's some risk of deterioration, with the risk of not being paid on state GOs, as I said at the beginning, after treasuries and agencies, probably the safest asset you can own.
Yeah, please.
So most of you guys seem to be focused entirely on the domestic market, and the one thing I've been very curious about, and I have been reading about, and we keep coming up with more and more solutions, printing more and more dollars. The dollar keeps rising against almost all the world's currencies right now with trading abroad. It's really a flow of funds more than it is, I think, it's fundamental. That is, as companies and hedge funds take their cash from the emerging markets and other places to meet their calls. Do you have any view that the end game of this is the collapse of the dollar? Do you have any position at all? I mean, it seems that you can't have $1 trillion. People would talk about a default of the U.S. Treasury, or you just can't keep printing money for more policies that we can't afford. So, especially against nations with reserve like Brazil, which really don't have to do much of anything in terms of floating any debt. I mean, how that would seem to me, if the dollar started to weaken, rates would go up, and this whole everything we're doing will only get cheaper because the economy will get even worse as the dollar should over time weaken against these other currencies, at least some of them.
Given that I've never professionally traded currencies except to hedge, I'm going to address your question and tell you that personally, I was long for quite some amount of time a lot of government obligations of other countries because I was worried about the dollar. In the past couple of months, I put it all into dollars. I think that what people don't understand, and I think is becoming very, very clear, is that the banking system in this country, as bad as it is, around the world, in most places, it's worse. I think that the European banks are so much more leveraged than the American banks that it's downright scary. You look at Asia, I think the data is less good, but all you do is you read the Lehman bankruptcy filings and you see where the exposures are, and it's not a pretty picture. For a while, I had some of my dollars in countries where, Canada, Australia, where there were a lot of commodities, but I'm concerned about commodity deflation in the short run anyway. I think it was Paul Volcker who said, inflation doesn't always flourish so well during recessions. I mean, longer term, I am worried about inflation. And then there's another aspect to it. I mean, the EU, I think, is really in a bit of a pickle. So I say that because over here, we have this printing press, and yes, we can print dollars, and yes, that has the effect, arguably, of devaluing the currency and so on, depending upon what else is going on in the world. The scary part is the EU doesn't have the mandate to print. That's up to the individual countries, and I do think this will be the biggest test that the EU ever faces, although I think the EU will clearly survive that test, or high likelihood survive that test. But individual countries, are having pretty significant problems in Europe, whether it's Iceland or Ireland, or you look at just the amount of. So the irony is that I'm not telling you that I like my dollars. They scare me. But some of these other jurisdictions are even more scary. But I'm not a professional in this area.
So you keep 100% of your personal assets in dollars.
I have the great bulk of my. I have a lot of money invested in our funds, and away from that, I mainly own U.S. Treasuries right now.
Anyone else want to be a macro investor for a little while?
We also don't trade currencies directly, but I would actually echo most of what John said. I think in particular, if you believe that this crisis is going to spin to the point where it's going to cause the collapse of currency, clearly the currency to look at is the euro, not the dollar. Because of, as John said, the euro is structurally not really a currency exactly, and it doesn't. And the European countries, besides having a more levered financial system, are much less well equipped to deal with the problem because they don't have the full set of tools in one place. They don't have the central bank and the taxing power and the treasury all under a common umbrella. And I think that's a huge problem. And if the situation gets worse, either the euro is going to splinter into pieces, or they're going to have to develop a strong central treasury function that they haven't had before, or the currency really won't work through a crisis like this. And the other thing I'd add is you mentioned we're talking about ideas in the U.S. principally. I think that's also a feature of this rolling top, rolling bottom theme, which is the U.S. markets got hit first. And the U.S. markets, therefore, I think in many ways offer some of the most interesting opportunities now. However far you are from the turn in the U.S., you're further from the turn in Europe. And I think Asia, where the downturn started later, frankly.
Yeah, we don't hedge we hedge currencies. We don't speculate in currencies, but I think the strength in the dollar is probably somewhat a flight to safety that you're seeing. I think longer term, I think people are concerned about inflation, but right now the evil is more recession and what that might do. So I think that you're seeing just a lot of flight to safety.
Take one last one.
My question is, there are today opportunities in closed-end funds in the areas that some of you like high yield, like single state muni funds. They're selling at 30% discount. And so if you think high yield is attractive at 1,200 over treasuries or whatever, you can tack on another 30%. Are any of you using closed-end funds, which are today these unbelievable discounts to the market?
We've never looked. We haven't looked.
We have looked some at closed-end funds. I think your statements are accurate. From our standpoint as an investment manager, there's two issues. First of all, liquidity tends to be very poor in closed-end funds, and therefore it's not so easy to actually buy them at the discounts as a substantial hedge fund as opposed to as an individual investor. And then the second thing, of course, is you're subject to the investment acumen of the manager. And so I think if there's an asset class you're interested in right now, and you can find a closed-end fund with adequate liquidity to meet your needs, and their investing style and their current holdings mimic what you're trying to accomplish, then it's a home run and it's great, and that's the way to go. Getting all those to line up in a lot of the things we want to do is an unusual occurrence. So yes, I think the opportunity's there. I think there are limits to how much advantage you can take of it.
I think they're very interesting opportunities, select individual opportunities in high yield. I personally, with my own assets, would be scared to buy a closed-end fund at a 30% discount for a number of reasons. Reason number one, they tend to often be diversified pools of the bottom of these capital structures. They tend to be, it's a lot of unsecured subordinated debt with nice fat yields, but right now I'm much more interested in being at the tops of capital structures, and I don't know of closed-end funds that necessarily are focused that way, point one. Point two, I'm very concerned about companies that have near-term maturities where, if there isn't financing available, there may be an issue. In other words, I want to be very selective about what I'm looking at. I'm focused on companies with liquidity where I can buy secured debt. Typically when I'm buying high yield, I'm not getting the 1,200 over. I'm getting a good bit less than that, but I'm buying things that I think are really safe. And I think the problem is you may buy some good stuff in something like that, but you may get a lot of much more ropey things.
I want to thank you, Brett, for putting this panel together. It was very difficult to get, first of all, John to get him to come out from Manhattan, and Steve from coming from Dallas. It was tough to come out here on such a morning, and I want to commend our speakers. Thank you very, very much, fellows.